The number one home buying credit myth is that inquiries are going to destroy your score. And I promise you that mortgage inquiries will not destroy your credit score. So if you're looking at getting a mortgage, you're likely talking with a couple different mortgage lenders. And those lenders are going to want to have a credit inquiry. So they want to do a hard credit check to see if you can qualify for a loan. Okay. Now let's talk through what this actually means. So getting a real mortgage approval requires a hard credit pull. So there are a lot of sites that will say you can get approved for a loan in 3 minutes. And really what's happening is they're doing a soft credit pull. They're looking at a little bit of your information, but that's not a guarantee that that loan is actually going to close. And when you're looking at buying a house, you want to make sure that your approval is actually rock solid, that you can actually close on a home and trust that your mortgage approval is solid. Okay. So there's two different types of credit pulls that can happen. One is a soft pull and the other is a hard pull. So first, let's talk about the accuracy of each of these. So for a soft pull, it's going to have less accuracy than a hard pull. And the reason that I know this is true is because mortgages cannot close with just a soft pull credit score. You might find a lender who will give you a pre-approval or pre-qualification letter just based off of a soft pull, but to get an actual loan to close on a home, you're going to need a hard pull, and that's because it's more accurate and a better representation of what your credit is like. Now, a soft pull does not show up on your credit report. And soft pulls are going to be used for with things like Credit Karma or your credit card website or ScoreMaster, all of the different sites where you can get your credit score right now. A hard pull will show up on your credit report and stay on there for a while. Now, the impact on the score, a soft pull does not impact your score at all. You can get unlimited soft pulls and there will be zero impact to your score. A hard pull is going to impact your score 0 to 5 points. Now, a lot of people feel like they're going to get an inquiry, and so they are afraid that they're afraid to shop for a loan because they think that each time they get their credit pulled, their score is going to drop lower and lower. And that's just simply not true. The CFPB actually says you have 45 days for unlimited mortgage inquiries. So if today I shopped for a loan with one lender, I could actually apply with 100 more lenders and it wouldn't change my score. Right? One inquiry can change my score 0 to 5 points, and the other inquiries will still show up in my credit report, but they won't count in taking down my score. All right. So a soft pull is used for checking the momentum of your score before you're actually getting a full mortgage approval. Okay. It's really good to take a look at, is your score moving up? Is it going down? Is the way that you're paying down credit cards actually changing your credit score? But to get that real pre-qualification and approval, you need a hard pull credit score. Now, what's so important to remember here is you have 45 days for unlimited mortgage inquiries, and that first inquiry will change your score 0 to 5 points. And this is because we've talked to so many people on our team. So we have a team of loan officers licensed in all 50 states at winthehouseyoulove.com. And we talk with so many people who currently are working with a lender, and we're able to offer them a lower rate, but they don't want to move forward with an approval because they think another inquiry is going to change their score. And it just simply doesn't. The law is on your side to protect you to be able to shop your mortgage without it tanking your credit score. Now, myth number 2 is that checking your score lowers it. There are a lot of people that feel like if they even look at their score, that all of a sudden it's going to drop. It's just simply not true. So there's 2 main companies that provide credit scoring algorithms. So you have Vantage and then FICO. So both of these companies have tons of different models inside of them as well. So Vantage is the most common soft pull algorithm. This is often used for maybe you're applying for a rental and they might use a Vantage soft pull score, or maybe you are just generally checking anytime you get a free credit report, it's usually going to be a Vantage score. FICO is going to be the most common hard pull algorithm, and this is what lenders are going to use. Okay. So when you're working on your credit, you only need to look at the momentum of your score. So many people are obsessed with finding, I need to know exactly what that number is, and it needs to be exactly what the lender pulls. And what happens is most of the credit scores you have access to are going to be different than the FICO mortgage score that your lender pulls. And that's perfectly okay. You don't need to know exactly what that number is. You're just trying to see, is what I'm doing, the way that I'm handling debt, the way that I'm paying off, the way that I'm using my credit cards, is that overall increasing my score or decreasing my score? There's really not a huge benefit of knowing exactly where that number is. We just want a general range before you then look at applying for a loan. Now, you can get an exact score at myfico.com if you want. However, getting that mortgage FICO score is more expensive if you go through My FICO. Okay. Now, momentum is going to give you feedback if you're on the right track. Again, that's all we're looking to do with credit. You don't get bonus points for knowing exactly what this number and having it at a certain point. You just want to see this number is giving you a good idea if what you're doing with your spending and with your credit habits is actually helping you or if it's hurting you. So here's a couple of different ways you can check your score without it impacting your credit score. Okay. One is your credit card dashboard. So if you have credit cards, likely those cards give you a free FICO report. Also, what I use for my personal credit is ScoreMaster. So ScoreMaster did sponsor this video. They have a $1 trial for 7 days, and you can go to scoremaster.com/Kyle. Now, what I really like about ScoreMaster is not only do they give you 3 bureaus, reports and scores that you can actually go through here and look at all the details really easily, but they also have quite a few other different tools. One of them is that they go through tons of different sites and check to see if my personal information is on it, remove my phone number and address, which I really like. That's all included with it. But also I can track my score. Just a heads up, this is not my score. This is a demo account. I'm not going to show you my personal information because you could steal my identity. But then also you have tools called Score Builder and Score Boost. So Score Builder walks you through an action plan to take action directly with the source that could increase your score. And then also Score Boost is this really cool tool that will analyze your current accounts and then show you if you paid down some of those accounts, what points could be added to your score or how it could impact your score if you increase your spending. So for instance, in this demo account, let's say we had an extra, let's say $2,000. I could see it could impact my score by 15 points here, and it would show me exactly what I need to pay, by what date, and then all the different accounts that would be affected by this. So I could see the biggest impact would be paying down this Capital One account, giving me 8 points in 22 days if I pay $1,142 by 3/11/24. Okay, so that's what I really like here is they have a really smart algorithm that can show you this simulation. Myth number 3 is that you can buy furniture or make any big purchase on credit before buying a house. I can't tell you the amount of times someone will go under contract for a home. They're 10 days away from closing, 10 days away from owning this home. And then all of a sudden they go and they finance a boat or they buy a new car or they put $10,000 on a credit card because they got some kind of rebate or discount if they put their furniture on there. Do not do that unless you talk to a loan officer first and get their okay. Large purchases with debt can completely derail your home buying plans, okay? Because your mortgage approval is based so much on your debt to income ratio, which is how much debt you have and the minimum monthly payments that you make on that, along with what your credit score is. So if you make a big change to your credit or even a moderate change to your credit, it can really impact if you're able to get approved for a home. All right, so talk with your loan officer first before you add any abnormal payments like furniture to your credit cards or taking out a new loan. Now, if you're just buying groceries, gas, things like that you always pay, you normally pay, that's perfectly fine. It's these abnormal payments that can completely derail your home buying process. Also, the underwriter is going to do a credit report refresh right before closing. So a lot of people hear this and they think, oh, the underwriter is going to pull another credit report and it's going to tank my score even further. That's just simply not true. Again, that first credit pull at the beginning changed your score 0 to 5 points. Okay. You have 45 days where any inquiries after that don't affect your score. But what the underwriter does before closing is they're going to do a refresh report where they're not even going to put an inquiry on your credit report most of the time. Usually what they're doing is they're just getting an update of the balances. They just want to be able to see, hey, did you go and buy a boat? Did you go and finance a car? Did you all of a sudden increase your credit balance by $10,000? And if so, it doesn't mean that you won't be able to buy the home, but your loan will have to go back into underwriting. If you bought a car, they're going to have to put that monthly payment in your debt to income ratio and hope that everything still works there. So talk to your loan officer before you make any big or abnormal payments. So myth 4 is that you need perfect credit to buy a house. You simply do not need perfect credit to buy a home. This is one of the biggest home buying myths up there with that you need 20% down to buy a house. The minimum down payment for a home on a conventional loan is 3% down. And you certainly do not need an 800 plus credit score to be able to buy a home. And I get it. It's fun to be able to have a high score and feel really accomplished about that. But most people aren't in that situation where they have perfect credit, and that is entirely okay. All right, 800 plus is not needed to buy a home. Most people who buy a home are around a 680 credit score. That's what we see on average. 640 is when loans tend to get easier to approve. So if you have less than a 640 loan, it's going to make the odds of you getting approved for a mortgage a little bit more difficult. Things are a little bit tougher. Your affordability is going to drop a little bit more. And that process is going to be a little bit more tricky to get through. However, if you have a 640 or higher, things start to get easier on all different types of loans: FHA, conventional, VA, USDA. Okay, so just keeping that in mind, you do not need this super high 700, 800 plus credit score to buy a home. Even if you have a 580, you can still get approved for an FHA loan. Now, myth 5 is that credit score is the only thing that matters. A lot of people spend so much time and energy into their credit because that's what everyone keeps telling them, how important credit is. And credit is one of the most important factors, but you also need a plan for your debt to income and your total upfront costs. Often what I see happen is people might have some extra money that they had from savings, and they take all this money and they go to pay down maybe their car or their student loans or some credit cards. But what they're not factoring in is that they also have to pay for the down payment and their upfront costs. And sometimes it makes sense to pay those first, move into a home, and then start tackling some of the debt that you might have, like a car loan or a student loan. But a lot of people will spend so much time on trying to increase their credit score as much as possible, but then they won't have money set up for their upfront costs, or they're not keeping in mind that another big part of getting approved for a mortgage is your debt to income ratio. And so sometimes what can happen here is either that you have too much debt that does need to be paid down, or for some people, they don't realize that they might need to actually see how they can increase their income to be able to afford a house that they want. A really good example of this is I have a friend who has student loans, and he's been paying a ton monthly on those student loans, somewhere around $900 a month. He absolutely doesn't need to pay that much on his student loans, but he also wants to be able to purchase a home. But because he's paying so much monthly into his student loans, he can't afford the upfront cost of buying a home. And so this is a perfect example of where it may be better for my friend to enroll into a program like an income-driven repayment program to lower the monthly cost of his student loans, so that lowers his debt to income ratio. He also then can limit how much he spends on student loans for a short period of time, be able to save up for his down payment and closing costs, buy the home he wants. Then once he's in there and comfortable with it, he can then make as high of a payment on his student loans as he wants to and restart that plan. So keep in mind that we have to get a balance between all of these different things, not just focus on credit and then not have money to be able to purchase the home. Myth 6 is that paying rent on time improves your score. Unfortunately, most landlords don't report rental payments to your credit score. And in some cases, instead, what we can do is add rental history to your loan approval. So we can't add it to your credit report. However, we can sometimes nudge your approval into the right direction by adding rental history to your loan approval. So the only time we're really going to look at doing this is if you work with us. Again, you can go to whenthehouseyoulove.com to schedule a consultation with us. So if you're working with us and you're not able to get approved for a loan, what we can look at doing is adding rental history to your loan approval to nudge that initial denial for a loan into an approval. And this doesn't work all the time. It's really only if you're kind of on the edge of getting approved that this can help. So you need a 620 for both a conventional and an FHA loan. And then the documentation that you need here is that if you're getting a conventional loan, then we need to do a digital asset verification where we have a portal. You log into your bank account and it scans your bank account for rental payments. On FHA, it's a little more lenient. We can either have your landlord fill out a verification of rent form, or we look at 12 months canceled checks or 12 months bank statements showing the monthly payment that you make for rent. Or if you're renting from a company, then we can get a landlord reference. Okay. Now you need to have on-time payments for 12 months for this to work. And you also need to be a first-time home buyer for this to work as well. So unfortunately, I don't know why this is really one of the, another point in why the credit system is just kind of this awful game that doesn't really make sense, is that one of the biggest payments you make monthly, your rent, doesn't show up on your credit report. But this is a way that we can use your rental history to help your loan approval. Now, myth 7 is that paying off debt impacts your debt to income ratio. Okay, so debt to income is a formula lenders use to see what you could be approved for. So there's a percentage of your income that you can be approved for. A good average is around 45% of your gross monthly income. Now, when we look at debt to income, we also have to include minimum monthly payments that you make on things like credit cards, student loans, auto loans. Okay, and again, it's the minimum monthly payment, not what you actually pay. All right. So if you paid off your credit cards monthly, that's not included in the debt to income ratio. I had someone email me recently and they say, hey, I usually put about $2,000 a month on credit cards and I paid off every single month. So would $2,000 be in my debt to income ratio? Absolutely not. What's included in your debt to income ratio is the minimum required monthly payment from the credit card and not what you actually pay. And if you're paying off that balance every single month, you usually will not have a minimum monthly payment on that because you're not carrying a balance. Myth number 8 is that there's nothing you can do to improve your score. And to some people, this may sound silly, but there are a lot of people who just feel like there's absolutely nothing they can do with their credit and that it's always going to be working against them. And that's really why I think you need to use a tool like a credit simulator to be able to explore what you saw on your credit report, see if you can take action on your credit report, and follow a game plan to add points to your score. And again, that's why I really like ScoreMaster. There's a $1 trial for 7 days at ScoreMaster.com/Kyle. There's also a link in the description. And again, the thing I really like about ScoreMaster is it makes it easy to be able to see what opportunities you have with your credit score. So for instance, right when you log in the dashboard, again, this is not my credit score. When you log in the dashboard here, not only can you track what's happening with your score and over time, what actions you're taking, how that's impacting your score. Again, we were talking about the momentum is what you really want to track with your credit report. But also you can immediately see what opportunity you have for your future score here through things like Score Builder, where you can take action on your account, and then also Score Boost. So I want to show you how actions work, for instance, with Score Builder. We already looked at Score Boost and seeing how different payments can impact your score. So Score Builder, we can click Take Action Now, and it will walk us through a 120-day plan to better credit. All right, so I'll go ahead and continue here. It will show us the goal score versus our current score here with what we want. And this was set up in the demo account. So we'll review our current score. I'm just going to fast forward through all this here. It will begin showing us what's helping our score, what's keeping our score the way it is right now. And we can examine all of these accounts and see what positive impact that it is having. Also, what's hurting our score. A few things that we might want to consider working on here. What's keeping the score down? Now we can take a look at the different actions and take these directly with the source on our credit report. So we can do things like fixing credit reporting errors, get goodwill corrections, paying off or negotiating small debts, and removing identity theft. So we can take a look at different action history. If you have a new account, you won't see any action history in here, but it will pull up the problem accounts on our score. So for instance, we can see a Citibank account, and then also it looks like a missed payment right here. Now, we can then take a look through what actions we have available to us and see maybe this was an error that we want to go ahead and take an action with. So you can click Fix Error, select a reason, and then take an action right here with this button, which I won't do again because this is a demo account. So if you're interested in trying out ScoreMaster, again, it's a $1 trial for 7 days. You can go to ScoreMaster.com/Kyle. If you have any credit questions, feel free to put those down in the comments and I'll go ahead and reply to those.